So I learned that instead of having that checkings and savings account kind of deal that a lot of people do, it seems as a way of not really putting in emergency funds as much as just keeping funds in that kind of buffer zone in
Yeah.
between investment and in between like property, right?
Yeah.
You put it there, but you can put that 50K or 10K or whatever into your mortgage instead. Except you can't, so you do it through a HELOC. So instead of having your savings account be the buffer, the HELOC is the buffer. And recently I found some crazy low interest HELOCs, so it's becoming more like, yeah, this makes sense to me. But the question I had was, well, I've actually been operating under a system where I put almost all of my extra savings into Wealthfront,
Yeah.
or like a higher interest savings account. I know that a higher interest savings account doesn't beat the HELOC strategy, as long as the mortgage interest, mine is the HELOC interest is higher than the savings interest. At least there might be something more, but I think it's at least that. But
yeah, more or less. Yeah, we can run through. I don't know if you got a chance to check out the spreadsheet that I sent you.
Yeah, I did check out the spreadsheet, but to be honest, I was a little confused by it.
Yeah.
I wasn't completely sure. Yeah.
So I figured this call would be, we can go over that real quick too.
That would be great.
Okay, great. So let's see here. So he went over the video and that explained it. I have some similar, he didn't do slides. He did like a draw out on a piece of paper, right?
Yeah.
I want to do a little bit of slides so we can go over that and then jump into trying to play with the spreadsheet. We can even use your spreadsheet with your numbers. That would
be totally great. Because
cool.
I feel like I'm in a different position where the amount of money I would hold in savings is much smaller in proportion to my entire mortgage.
Yeah.
And if I have 50K sitting around anyways, it'll be in a investment account, you know?
Exactly. And you can always like, hey, the investment account, like you got the HELOC, you got a buffer there, and maybe you want to pull some out depending on the interest rate and just shove it into the, let's say it's, I don't know, sometimes the HELOCs have no interest for like 24 months or something, 0%.
Yeah. Oh, that's true. That's true.
36,
then I should all of it and put it in the
shove it all into the Wealthfront.
Like,
I mean, you're taking some risk there.
There are some risks, but like, as long as I don't have to make up the entire 50K. As long as I have confidence that the stock market isn't going to drop like 50%.
Yeah.
Like I'll only put in what I think I'm able to recuperate. Yeah. So luckily, because I'm still working, I can, if I have to, I can recuperate a lot.
It's your risk tolerance, right? And everyone's risk tolerance is different. Personal finance is personal. So, you know, I could like, if my risk tolerance was higher, and for me it is, but for others it's not, I could go take the money from the HELOC, shove it into Wealthfront, and then if you needed the cash, do a margin account against that.
Oh, I don't margin account. Well, I'm
but that's like just adding another.
Is it like a loan against the Wealthfront account?
Yeah, and I don't know if Wealthfront does it, but M1 does. M1 Finance does it. I think Robinhood does too.
Oh yeah, I bet Robinhood has so much stuff. Oh my god, some of it is a little bit intense.
Yeah, it's like,
the guy who's like 700K in debt after spending 50K or something. Yeah, crazy.
Oh yeah, and then he ended up. Yeah, that was pretty tragic.
No, that was
that was a different one.
But like it was like one of the, I forgot like there's a name for it, like one of the people who was like, wow, Wealthfront lets you trade with 100 million with like 1 million in leverage if I do this.
Yeah.
Yeah.
So I mean,
about those guys, and they're up and they're up and they're up.
Yeah, I mean, if you needed cash, well, you'd probably just pull it out of the HELOC. But if you needed cash and you wanted the cash invested, and you needed, you know, I mean, ultimately, it's your money / the bank's money.
Yeah, I get it, and the risk is set up too.
There's risks right there, but yeah. So all right, let's go through, kind of just reiterate what you saw from the video. I'm gonna share my screen here. The point of the strategy, to kind of reiterate from what the Kwok brothers showed, is that here's your money coming in. Let's say it's 5,000 income, and then by the end of the month, or money comes in, and then you know you do all your saving or your mortgage, your car, credit card, lifestyle, etc., and then anything remainder ultimately becomes your savings, which you know usually you just shove it into a checking or savings account. But have you ever wondered why you put it in a checking or savings account? Like,
I actually never put it into a savings account or a checking account. I mostly put it into investments. Right now,
investment. Okay,
actually,
so you went straight.
right now,
That's smart.
right now it's all in my 401k, which was also a bad decision because I'm realizing I can't really use it.
Well, you can. I'll show you some ways to do that.
Okay, cool.
Especially with the CARES Act, that made things so much easier. But even without that, there's ways to
Okay. The only
use
two
that
ways I
money.
know about is the loan against it
Yep.
and withdrawing, and both of those seem unattractive. So I'll have to hear from
Yeah.
you.
The
What better?
withdrawing with the CARES Act in particular, might as well just talk about that now. Yes, it's loan or withdraw. Loan, usually there's some sort of fee, a loan fee, which is like a one-time thing, or maybe it's an
Yeah.
annual thing. It depends on your brokerage, or the account management portal. Like I use Guideline with my work, and there was like a $75 loan fee.
Oh yeah, whatever.
Yeah, and then I could borrow from it. But CARES Act, that was passed in April. It goes back to April 1st, allows you to withdraw up to $100,000. Normally, you can borrow up to
Only do 50.
$50,000. Yeah, now they doubled that to 100,000. So you can straight up either borrow against it with no payments for a year, or withdraw it completely. But if you withdraw it, the taxes are due, but normally the taxes are due, the amount you withdraw, the taxes are due as if it's regular income. If it's if it's Roth, it's already post-tax money, so there won't be taxes after that. But if it's a traditional 401k, the taxes will be due. But with the CARES Act, they took the taxes that are due and they spread it out over 3 years. So that's cool. And then if you put it back in within 3 years, all of the taxes that are due is refunded. Yeah. Isn't that cool?
So that's basically like a loan.
Well, yeah, it's basically like a loan, but it's a withdrawal. And
Zero
then
interest, yeah.
zero interest withdrawal. There's no, exactly. So that's
10% penalty for early, right? But that's it.
Right. Normally, yes, but the CARES Act removed that.
Okay. Is
So
that
if
the
you
coronavirus
needed
only act?
What was that?
Is that the coronavirus act?
Yes,
Or?
coronavirus. What is it? CARES.
But it feels like I feels like I won't be able to do that to buy a house for the down payment.
I don't know. It depends on your how much you need and how much is in your
Okay,
account,
cool.
Yeah, but if you needed to, you could do that. And anyway, if it's a primary residence, you could withdraw with no penalty anyway. But that's without the CARES Act. But the CARES Act allowed you actually to withdraw it for any reason with no penalty.
Okay.
So get with a CPA to do that. But that's what I heard from the folks I learned from. So anyway, you can access that. But back to this. So normally, most people have a checking or savings account. You probably put all your money, they probably direct deposits into a checking first, and then you shove it back into Wealthfront, right? Or wherever.
Yeah.
Brokerage. But a lot of people just leave it in there. It's like, what are you doing? So
yeah.
You just leave it in there, and it's like, you're leaving it in there, and you have debt on literally any loans. Like, if you're gonna leave it in there, it's because you have no more debt.
Not good.
You have nowhere else to put it.
You should pay off the debt first. Yeah.
Yeah. So and here's why. So that's what happens normally, and then you're out. Your cash flow is zero. Well, cash flow is zero because you're not tapping into your savings. But we're gonna turn your savings into cash flow, and we're gonna turn other things into cash flow. So here's a question: is this true? Well, you see the slides next to it. That sucks. I scrolled.
Well, yes, right? Yeah.
Yes-ish, but how about now?
Oh, yeah, no.
No, right? Exactly. So the main point of this question is, how about now?
Oh, yeah, then it's true again.
Then it's true. So the main point of this question is that these are different units. All we see is the degree symbol, and then you have an additional unit that is either Fahrenheit or Celsius that determines what scale it's in, right?
Yeah.
So if you ask I don't know, a 5-year-old which one's hotter?
Oh yeah, they'll be like 32. Yeah.
They'll be like 32, but it's like, well, they're different scales. 1 degree Celsius actually ends up being hotter, and that's the same thing with interest rates. Now, the problem is that interest rates don't show that second unit.
Oh, I see. I see you're getting it here. It's like the 21 interest rate for like a year versus like 6% for 30 years.
Yeah, exactly. And front loaded and then amortized. Well,
Yeah,
amortized
that
first and then front loaded.
yeah, those are I don't quite get the like I get those, like I've seen the curves
Yeah.
and I get why, but like it seems weird.
It seems weird. Yes, exactly. But that's how loans are calculated. And now there are some loans. I believe student loans are not like that. I have to double check. But student loans may not is not front loaded. It's like, and for example, I
I
have a
currently don't
loan.
have student loans, so we don't have to. It's okay, yeah.
Okay, great. So I have like a loan. I know, for example, my life insurance, one of my life insurance policies, my whole life policy with Gerber has a 5% simple interest amortized annually, or not amortized, compounded annually and not amortized. And because it's not amortized, there's no amortization schedule. I just pay 5% simple interest compounded annually. So it's like, if I don't pay it within the year, the 5% gets tacked on in January and then do it again.
Yeah.
And so some loans operate using the simple interest model, not front loaded, but mortgages do not. And anything generally when there's like a fixed period, it's like, oh, car loan, 5 years, whatever. You know, generally those are anything that has a fixed monthly payment that divides the entire balance over a fixed amount of time, like 36 months or 5 years or whatever. Or in this case, in a mortgage, 30 years. Those are gonna be front loaded and those are gonna be amortized. So the difference is like a line of credit, like a credit card, a home equity line of credit, a business line of credit. Lines of credit are super powerful in that they operate similarly to credit cards and checking accounts, and savings accounts too. Money goes in, money goes out. You know, whatever you're left with. That's
I see. The 3%, saving 3% on the mortgage is different from saving 3% on like a line of credit. Because a line of credit, as soon as you take it out, it's no longer it's done. Like if you take it out in like a day, you didn't pay 3%. You paid like whatever percent.
yes.
But isn't a mortgage
Day.
the same if you sell it? Like if I sell my house in 10 years or something, isn't it also less? But 10
It's a
years is a
little
lot
less.
more.
It's a little less. It's based on
Okay.
this slide here.
Yeah. Okay.
It's only a little less because every payment, it's front loaded interest. Unfortunately, most of your first couple years, maybe let's say you don't get until 20 years on a typical mortgage like this, where it's like $1,200 a month. You don't get it. It doesn't hit the threshold, the crossover point where it's 50-50 until 20 years from the first.
So I've seen also some examples where some banks let you pay principal first.
No way. That would be cool.
Okay.
I mean, you can always put more money into the principal, but their minimum balance, like 90% of that is going to be interest, and then 10% of that is principal.
Gotcha. I must have like misunderstood it.
Initially.
So it's like, so they force this ratio.
Yeah.
To make sure that they earn money, but
yes,
if they made it so that you have to pay only interest first, then they're worried that people wouldn't take their loan, right?
Yeah.
Okay, so it's just a curve, not because of math, but because of people.
They front load it essentially, and basically your payment schedule is such that this much percent it goes to the interest first.
Yeah.
Over 30 years already, so you're paying technically 30 years of interest up in the first year or two.
Yeah.
Like, you know, and then you see what happens usually 5 to 7 years in, they'll refinance and then they start over a whole schedule. So
yeah, I didn't know that the refinance resets.
What was that?
I didn't know that the refinance resets the schedule at like 0 years, and you have to like pick 15 years or 20 years or something. But it still resets the proportion of
still resets. Yeah.
Now.
Well, what they'll see is, oh, you have this much principal balance. We'll take that principal balance, we'll compound it another 30 years.
Yeah.
Sure, there's a new rate, and if sometimes a refinance via a mortgage refinance, or rather a home equity loan, makes sense sometimes. If like you're going from a 5% rate to a 2% rate or 2.5%, maybe it makes sense to just restart the schedule. But just keep in mind, depending on how far into it already, you've already
there's cost.
The chunk of the interest right here. You know, majority of your first 5 years are interest only. Not interest only, but they're amortized interest for the entire 30 years, but you didn't even get that far. Now, if you're too late into it, you've already paid the majority. It's like you're like 10 years in, 15 years in. Okay, you know what? You already paid the majority of the interest. The rest of this is basically principal. So like, don't refinance. Just pay it. Just keep paying it as is. Now, if you're early on, it might be a good idea still. Now, mortgages are fantastic tools to acquire property, but they're not great for holding on to them long term, like the 30
So
years.
one more question. Is this why a lot of banks don't let you make principal only payments?
Well, you can always make principal only payments unless there's a prepayment penalty that if you wipe out the balance,
Gotcha. But if
then
you make a principal only payment, but that would just like pull down the red line though, right? By a lot.
what it'll do is it'll take see this line here, it'll jump start you ahead to the amount of principal you have left. So you make a principal only payment, this line moves left and right, well, to the right as you make more principal payments. So you just watch this line, and this is technically in this slide a refinance line, but if you made principal only payments, you'll jump start the schedule and skip all this red part. The area under the curve, this is calculus. The area under the curve is what your payment is.
Yes.
Oops.
Understood.
Okay.
Thank you.
So yeah, of course, this is what this call's about. I'm like, let's really tackle this. And like, it took me forever to wrap my head around until I realized this. I was already doing this because I use my credit cards as my bank accounts. I've been doing that for 5 years.
This is the same thing because you use your credit cards to finance the down payment for the house, right?
Everything, yeah. I bought my first property, my 3-unit rental property. I used $15,000 of the down payment. I used $15,000 from that credit card as my down payment, and then of course I also like use a ton of credit cards to fix it up, make the renovations and all that. The rents, pay those back. I also did the same thing with my Airbnbs, credit cards to. I had a promotional period on one of my cards at one point. It was like 2% for 6 or 12 or not 12 months. It was like until June of 2019 or whatever. But for like 7 or so months, more or less, I had furnished I had furnished 4 units of Airbnb. 4 units of apartment to convert it into an Airbnb, spent like $11,000 on it. And then just, it was very low interest. And then I used the Airbnb income to pay that back down immediately. And before the promotional interest rate was up, I had wiped down the balance on that one card. So anyway, so normally if you make 48 payments, that's not 2 years. Is that 48 payments of $1,200 a month? Yeah. It's 4 years. So the first 4 years, we're right here, almost 5, not yet. This, we've already paid $1,200 a month times 48 is $45,000 in interest and $12,000 worth of principal. Just there. So all of that good chunk was just interest. Now, we're going to change it up. So we're going to use the bank's own tools against them. It could be a different bank, doesn't matter. It could be the same bank, Chase Mortgage and then Chase Credit Card. Yeah. Or Chase HELOC or something, or maybe not Chase HELOC, but you can shop around, doesn't matter. You use a line of credit, ideally a line of credit that increases in credit limit as you pay it down. Yeah. And one way that a HELOC does that is you can increase the equity if your house appreciates. You can take out more lines. But on a credit card, you use it up, you pay it down, the bank likes it, you hit the credit limit increase button, and then they, maybe double your credit limit. But the point is that the more credit limit you have, the faster you can do this. Because we're going to use a line of credit, like a credit card or a HELOC to do revolving. And it's simple interest calculated on an average daily balance equation. So you take the what your interest rate is for a whole year and divide it by 360 or 365 days or something. And then you get that daily rate. And so whatever balance you have on a day is the interest gets charged for that day. Yeah, I get it. Accumulates. So rule number 1 is lines are better than loans. And then rule number 2 is that, as a W-2 employee, generally people just, a lot of people live paycheck to paycheck where their cash is their currency. They get the money, they spend it, and then
So
they're
I
stuck.
get rule number two. I get rule number two, especially after learning the
You
house
did?
thing, where like if your house goes up 20%, you're up 200K on a 1
Mhm.
million house. It's not up 20% of your down payment. Like it took
Yes.
me a while to get it, but I get it.
Yes.
Lines are
Great.
better than loans. Why are lines better than loans? Only because they're revolving and they're not fixed term.
Exactly. The principal's liquid as well. It's two-way, meaning you put money in. Oh, all of a sudden next month, I don't know, car breaks down, you need that money back out, pull it right back out. Now, if you made a principal only payment to your mortgage for the same amount, you
It's
put
in
that
forever.
money in, you're not gonna go call your mortgage bank and be like, hey, can I get that extra payment back?
Yeah, you
They'll
can't
be like,
you
no.
can't just take extra mortgages for fun.
No, exactly. So the flexibility is one. You got that little bit of security because you got a cash, quote unquote, cash cushion. And then, so it's two-way, that's important. And then the fact that it's not front-loaded interest. It's simple interest on a average daily balance that actually, since it's not compounded over the 30 years, it's cheaper in that sense. People are like,
Well, in
oh,
a
21%,
loan,
why
let's
would
say it this way,
21%?
right? If you wanted to buy like a $300 thing, you could buy it with a credit card with like, let's say, a 3% interest, right? But
Yeah,
if you took a loan for $300, you could also do that. And if you paid back the credit card in a month, and if you paid back the loan in a month instead of like the 2 year time period, wouldn't it be the same?
sometimes it depends on the loan, but most loans are going to be front-loaded interest, meaning they took
Gotcha. So
that
you
they took
can't.
that year, all the interest for 5 years or however long it is. Let's say 2 years. If it's not a 0% interest financing, then now if you then you they took that entire amortization of 3 years worth of interest and compressed it
I
um,
see. So
into the
it's like
front.
you only had 20% efficiency in paying
Yeah,
things back.
exactly. And like in that sense, in that regard, you might as well just don't pay it off until the very last period. And actually, if you don't pay off
I
your
see, I
loan,
see.
it
So
boosts
then
your
this is
credit.
where people feel that credit cards are dangerous because you might not ever be able to pay them back. But at the same time, if you can use it right, then credit cards are better than loans
Correct.
just because you're only paying, if you know you can pay something back faster than a loan period, then you
Yes,
should use a credit card instead.
precisely. And people don't get that. They're like, oh, credit cards are dangerous. Well, they're dangerous if you treat them like loans. No, loans for loans and lines for lines, kind of. Like
Yeah, I get it.
if you don't keep the money moving in a line of credit, like a credit card, then
Oh,
you'll
it fucks
constantly
you up.
pay more.
It's
It'll
like
cost you a lot.
because interest rates are higher. Yeah, okay.
Yeah, because it'll actually start to compound, and compound interest starts to work against you. Now, if you take a month, if you put up a balance in a month, actually up to 55 days, because if you do 30 days for the statement period, let's say the first of the month, and your statement
Yeah,
closes
because you
the
pay
30th.
no interest up to the statement, right?
Yeah, that, and then you have 25 days to up to 25 days to pay the statement back. So you have 30 plus 50 plus 25 days up to. So you make a purchase on the first, and you don't need to make the payment until the next month's 25th.
I understand it now. Yeah,
And
you're
there's
good.
no interest. You end up carrying a balance, so that sucks. Um, you know,
But yeah, like whatever. Like your credit is lower
yeah,
by like 20 points or something. You just pay it back.
it might. And I experimented with this many ways already. I've swung my credit score from 650 or 620 even all the way up to 780 in a matter of a couple months because I just moved the money
Yeah,
around.
juggling the algorithm. Yeah, that's
Just
funny.
juggling, right? So essentially, because of that, if we're using leverage, which means debt, we're leveraging the bank's money. That's the currency that we use. That's what we spend money with. And by spend, I mean redeploy funds to invest in other properties or make improvements to the house, etc. And in cash, the more cash you have, the more cash flow you have, the faster the money moves. And the faster the money moves, as long as you're using a line of credit, the less interest you have because there is
Yeah.
less average daily balance.
By faster it moves, you're talking about like buying something and paying it back within a week or within a day where the day is faster, right?
Whoops. You pay it back. Yes, you not necessarily the same day, but even if you pay it back within a matter of 2 months, 3 months, 4 months, it's still
Yeah,
going to be cheaper because you're not paying that entire amount.
30
Um,
years.
Yeah, for 30 years, essentially
Okay.
worth of interest. So lines are better than loans, and then we're going to use leverage as currency. Currency being what we buy and sell stuff with. So you take the money coming in. First thing we do, we're going to wipe out that. First thing we do, we're going to put the entire payment on a credit card. Wipe
Yeah,
out the
bam.
balance. You can even make an overpayment. But probably, if you have some credit card debt or some other, like we're trying to leverage the line of credit um, to its full advantage. So we need it cleared out first.
Yeah.
Because you had some probably, when I was had a ton of balances left on my credit cards, I just took all my income, just shoved it at it. Forget the minimum payment. So the minimum payment goes away. And then not only that, we're actually going to get rid of our savings. Counterintuitive, but we're going to get rid of our savings and we're going to apply it to the credit card too. So now we've applied $2,000 worth towards the lines of credit, which, if we had a $12,000 balance, this is the average. This is from nerdwallet.com. The average American has $12,000 worth of credit card debt. You took 5,000 of that, which is also the average, I guess, the middle class income, $60,000 a year, median income, 5,000 a month. So we took that, and I guess these are gross numbers. So, account for taxes, whatever. Let's say net 5,000. So we put that in. Now the balance goes down, but we have expenses. So we're gonna make, I pay my rent on my credit card as much as possible. I'll pay.
Oh yeah, that's super late.
Everything.
Back. I wish.
And how to do that? There's, either if ideally if your apartment, your landlord lets you pay with a credit card, or
yeah, mine's they charge like 3-4%, so it cancels out.
It can't. Yeah, if you're doing it with sign up bonuses and stuff, it makes sense, but maybe not all the time. Now there is a way to do that using manufactured spending, which is another strategy where you buy gift cards from the supermarket and then turn them into money orders, deposit them as checks.
I remember that. Yeah.
Yeah. So that is how I pay. Well, if I didn't want to pay fees, I'll pay 1.2% on the activation fee of the Visa debit card.
Yeah.
Well, it's a prepaid gift card, but you turn it into a debit card by
yes, but you get like 3% on the credit card.
Yeah, well, yeah, exactly. So actually, Chase had a promo that ended at the end of June that was up to $1,500 per card. It was 5x back. So I actually got 5% back while I spent 1.2%. So I profited in terms of points. And then you could even redeem the points against your groceries that you just use. I mean, they're groceries, but any merchant that codes as a grocery or supermarket, you could redeem your points against it at the same rate that you could redeem your redeem points for travel. So they added grocery as a redemption at 1.5x. So that was cool. I didn't use that because I like to accumulate my points for actual travel. Free travel, that's the way to do it. Side thing, but that's, all these strategies start to come together and I'm like, this is super powerful. So we go income and expenses. Expenses go up, your mortgage, how do you pay your mortgage on a credit card? There's ways. How can you do it? I can't do it. That's Robert Kiyosaki, right? Ask yourself how you can do it. So all your expenses, your food, etc., come in, and then the next month your income goes in again. Same thing. You just keep repeating that. If month 4, emergency happens, your car broke down, you need new tires, whatever, the balance just goes right back up. But already we've deployed all of our savings and all of our income against this cash flow. Now this only works when you have positive cash flow, meaning you can't be doing this when you're paycheck to paycheck. There's no savings to work with. The savings is being redeployed as a way to save on interest because we lower the average daily balance on the line of credit. So we move, if there's no emergency, we just keep going and bam, pay off in 6 months. 12K to 0 in 6 months. For a lot of people, that's like, wow. they couldn't think they couldn't think of ways to tackle 12K of credit card debt. And yet this works if they had, in this hypothetical scenario, there's $1,400 of savings. Now, some people really have no savings and don't have cash. Their cash flow is 0, meaning income comes in, out, expenses come out, it's 0. If it's like that, then this won't work. So this only works for people with at least, any amount of cash flow. And there's ways to increase your cash flow.
I get it.
Yeah.
It sounds like this works because you took the money that you were putting into savings and then you took the money that you were putting into other things and just used it to pay down your credit card debt,
Yeah.
which is better because if you put it into mortgage, it would have gone to interest anyways. But now it's going
Yes.
straight to principal.
Yes, exactly. So actually, that's where we're going to lead right into that that next step. We have saved on where by redeploying savings into tackling the daily balance of a line of credit, we immediately drop the interest because the average daily balance is much lower than if it was at 12K. So we're going to take, oh, and when this happens, you pay it off. Usually you call up your bank, you get a credit limit increase, or you just go on their website, hit the button.
Yeah.
They give it to you. Sometimes. I mean.
Yeah. Mine's is way higher now.
Yeah, exactly. I mean, like I've regularly, I'll go in the portals or call them up and be like, can I get more? Or sometimes they just give it to you.
Yeah.
They want you to use your cards. And because they make money on the merchant fees. They make the majority of the money on the merchant fees, not on
interest
you hold it, not on your interest. Interest, you look at a bank's bank statement or a bank's profit and loss statement, you'll see the money they make from interest is actually very little compared to the money they make from merchant fees.
That's good to know because it makes me realize that they're not trying to profit off of that as much as they are just with the merchant fees. Yeah.
They want you to keep using your cards, so they'll increase your limit so that you'll use your card more, but they don't want you to keep. They don't want you to hold your balance on there long term because then they'll start to see you as risk. That's why your credit score drops because of your utilization.
Gotcha.
And now you have this much in savings. And by savings, it's quote unquote savings. Like all of my savings for the most part are deployed in cryptocurrencies that I borrow against from or lines of credit that I borrow against from. So, whoops, yeah, that was it. So we've knocked out our credit card bill. We've knocked out our savings. Maybe you want to keep like $1,000. Just I keep a good chunk of money just to make sure that I can make any auto pays that I set up. So you want to systematize these things too. So set up auto pays and all that. Sometimes I set up an auto pay and I forget that it comes through on that date and I didn't have enough money in the checking account for that credit card.
Yeah, don't let that happen. But that's I get it.
Yeah. So anyway, we knocked that out. We have extra cash flow, and then the minimum payments, since they got knocked out, there's extra cash flow too. So there's more ways to increase the cash flow. If you're living paycheck to paycheck, let's work on increasing cash flow first, then work on doing this. Now we're in a position where we've knocked out the credit card debt at this point. At this point, we're going to re-leverage that same tool. And I keep saying credit card, but this works with any line of credit, including HELOCs, and especially HELOCs because they have lower rates. But we're gonna take a $12,000 principal only payment from the loan and apply it to the credit card. It's the same amount of debt. We just moved it from one pocket to another. And if you remember earlier with that schedule, by doing that, we do the same strategy. Income goes in, money goes out, et cetera, et cetera. We've actually intentionally increased the principal, or not the balance on the credit card, but we want to increase it strategically such that if you care about your credit score, your overall utilization of your credit
stays the same.
should be 30% or less.
Gotcha. Yeah. So that's why we're not keeping it at 12K forever. That's why we're letting it go back down to zero.
We're letting it go back down to zero because some of those months, you know, you want the low balance. Some of those months you don't care. Like you're not shopping for a house. Who cares what your balance is?
Wait, I have a question. So what you just did, we just made a $12,000 principal only payment to the house. So we moved that line to the right, using our credit card, right?
Yes. And
okay.
If we go back to the slide where we look at the amortization schedule, what we did,
we just moved it to the right.
We just moved this to the right. And the reason we chose $12,000 is because it's the same amount we would have paid in 4 years.
Oh, nice.
And
I see.
look how much savings you just did. $45,000 worth of interest. You just skipped this line from 0 to 4 years in a matter of one move.
It's because instead of paying the $12,000 plus 30 years of interest, you're paying $12,000 plus 6 months of interest at a higher credit card rate, but it's only 6 months.
You got it. Brilliant.
Okay, cool.
Yep, that's it. That's exactly it. Right. It took me forever to wrap my head. So like, it took me forever to wrap my head around this. And so like, people always just be like, you know, this strategy is stupid.
Here's the thing, the current interest rates are really low, right? So instead of 6%, they're at 3%. I think this still saves a lot of money in the long run, but
yeah,
it's still expensive, you know?
Yeah, so that's why we want to look at the spreadsheet. Sometimes it doesn't make sense. I'm not saying this works at all times, you know, sometimes it doesn't make sense. You get a 2%, 3% mortgage that's a primary residence. Those are the best rates. They're great for acquiring those properties. Now, if you can get, let's say if you had some additional savings and cash flow, like why pay the interest on that amount? What you would do is you take out the maximum loan that you can have, and then
maximum down payment.
immediately jumpstart yourself with a principal payment.
Yeah.
Like it almost makes sense to like put in as little down payment as possible. And then as soon as you close, you put the money that you would have put as down payment against the loan. You get the best of both worlds that way.
Wait, why again? Sorry.
Why? Okay, so if you have if you put in a high down payment, you have a lower monthly payment on the mortgage, right? And that makes sense.
Yes.
So if you minimize the down payment, you get a really high mortgage. So that might not be a good idea in terms of your cash flow. It depends on your goals. But if you had this money, and then you tackle it. If you didn't have the money, the point basically is that if you put the down payment in and then the rest is on a mortgage, and then you immediately had that cash available, perhaps from a credit line or whatever. Let's say you didn't have the savings, but you pulled it from a credit line, and then you make the credit line payment, the $12,000 or whatever. You immediately jumpstart your amortization schedule, and you skip that entire first block of interest-only payments.
Oh, gotcha. So
just
you're
like
saying it's better. It's better to do a smaller down payment, because with a higher down payment, you still have the amortization schedule, and you have to do the math to make sure that you're still not paying more interest.
Yeah.
Okay.
So
okay. I didn't know that.
That's true.
That's
true. Spreadsheet. Every number is going to be different. Like, I'm not going to say this works no matter what strategy, no matter what house you buy, no matter what your balance is, no matter how much.
Let me just write that down really fast, because that sounds, now I think I understand it, and it makes me so mad.
Yeah, once people get this, now this isn't even new. This idea came from Australia. The founder of our company visited Australia, was wondering how the mortgage and the banking and the home lending situation worked there. And Australia, actually, you're not allowed to own land. You only own the
like Hong Kong.
The land. So that's kind of cool too. In that, technically, the land belongs to the native.
Like Hong Kong, right? You get like 99-year leases.
99
I think
year
it makes sense, because it feels more equitable, but it's hard to say. Yeah. It feels more equitable.
Some strategies about that. It's like, okay, do you want to buy a house that the lease is coming up on the land? There are some of those. It's like, hey, the prices of houses, actually improvements built on top of land that isn't tied to the house. Actually, like, that's where you get big discounts. But is that really a good idea? Because you're gonna have to renegotiate that lease once it's due. So like 5 years before a lease is up, the house value of something that's on a land lease is actually like, it plummets.
Great. Is that where? But then you make it really shit. Anyways, all right.
Yeah. No, anyway, that's just some acquisition strategies. And then it's like, what about the credit card interest? Well, here's the math for that. Let's say it was a 21% credit card. Sometimes it's more, sometimes it's less. It doesn't really matter, because it divides by the number of months. And this is actually an overestimate, because when you just take the 21% divided by 2, because you paid it off in 6 months, it doesn't take into account the stair step that we went through. The ladder here, the average daily balance isn't at 6K for 6 months, or isn't at 12K. It's less, right? So it's actually less than 1260.
It's like almost like, it's like 3.5 or something.
Yeah. I mean, again, it's slight calculus, but this is an overestimate. This is the maximum amount you would pay if you kept the balance of $12,000 on a credit card.
Can I take a screenshot?
Take it, yeah. Take as many screenshots as you need. Just don't share it with anyone. I'm gonna share it my own way.
Okay, cool.
Yeah, that's why I want to record this, because I've been meaning to get on a conversation with someone and go over this strategy and have questions back and forth, so I'm not like talking to myself. But I'll put this on YouTube, and you can go over it and reshare it. Okay, so here we go. This is how much money you'd pay in interest in a matter of 6 months on $12,000 of principal. That's what we're keeping constant, is $12,000 of principal. If you did to get to $12,000 of principal on the mortgage,
right? You'd have to pay like, you'd have to, even if you made a principal only payment. Well, wait, hold on. Okay, this is
This is
enabling
it.
us to make higher principal only payments than we otherwise would have been, right?
Precisely. You could
Okay,
just take your savings and be like, oh, I'm gonna make extra $1,400 balance or 2,000 or whatever it is. And some people do that, and sometimes it makes sense. But the problem is that once you make that principal only payment, you need 2 grand next month. You didn't know. You can't
right.
pull that back
So
out.
so
You're
you're
screwed.
forced to only put like 600 in, 300
Yeah, you're
in, and
forced
it's
to.
less.
Exactly. You're not deploying. You're not maximizing the deployment of all of your available capital. And by that, I mean not just savings, but your credit lines. Those are available capital. You can theoretically, I could, if I needed 50 grand tomorrow.
You take your 5 credit cards and I just go boop.
Yeah, I'm going to take 5 credit cards, well, maybe not maximum. I'll probably, it's better
Yeah,
to equalize
half on each. Yeah,
the utilization and be like, all right, let's do 30 to less than 30. If I can, the more credit limits I have, the lower my utilization can be. Right now at this moment, just personally, I've got like $100,000 in lines of credit. Maybe, yeah, I think so. And then if I needed 30 grand, that's 30%. I could borrow 30 grand and it wouldn't negatively affect my credit score too much. Actually, some of them credit lines are on business cards, and so it really won't affect my personal credit score.
yeah,
And
it's fine.
actually, most of my business credit cards are maxed out because they're 0% interest and they don't affect my debt utilization.
Yeah, 0% interest is crazy.
Yeah, really powerful.
That's free
when
money.
you use those. Yeah, it's literally free money. That's how I bought my first house. Is 15K,
Oh,
0%.
with the business. Oh, yeah, with the deal.
It
With the
wasn't even a
24
business,
month.
actually. I dinged my personal credit score by doing that, but
Like
it
whatever.
didn't
You
ding
have a
it
house.
enough. I dinged it to bring it. I borrowed 15 grand. That was the only, I think that was the only balance, or maybe my total balance would have been like, I remember
Yeah,
my
I have some more
utilization
specialized
being,
questions to you after this though,
yeah, yeah.
because yeah.
Yeah, so let's go back to that. But anyway, it's like utilization under 30%, you're good. If I needed to pull 30 grand from credit cards tomorrow because I need to put a down payment on a house that is gonna go away and it's a really good deal, I'm gonna do it. And then I'm gonna pay that back next month or 2 months from now and just pay a little bit of interest, or maybe none.
So it
So
seems like the takeaway is make sure you can only use as much credit that you can make sure to pay back within like a couple
yeah,
months.
and it'll ding your score if it's on a personal card, but not too much. Like it didn't stop me from buying the first house. I got a 687 FICO, or maybe it was
Oh
687.
yeah. I'm not worried about my credit score. I
Yeah,
think as long as you keep it
this will
reasonable.
ding your score if it's on personal
Okay.
line of credit. So there's a sweet spot where it doesn't ding your score too much that it keeps you from buying a
Well,
house.
with the 25K, if you increase your credit line, then it dings your score much less. So
Exactly. So keep increasing the limits and just don't use them
yeah.
unless you need them for investments and such. That's the only reason I use I use them. So anyway, 12K payments. You do it again. You do it again. You do it again. Repeat until the entire loan, and this could be a car loan. This could be a mortgage until it's paid in full. And that's how you can take 30 years and compress it to 5.
I see. So
Because
I
you're
understand now that it's more complicated than just interest rates. So before I decide to put my money in the savings account or an investment account or in my 401k even, I should probably do the math just in case.
do the math, right?
Because
And then,
right now Google lets you do the backdoor 401k for no
yeah,
additional paperwork. You click a button and they do it for you.
nice.
And I think some people are really mad about it because it's like, oh, it's illegal, but it's not illegal. It's just
It's
Google
the
makes it
rules.
easy.
It's the
Yeah,
rules. You're literally
it's
following the
literally
rules.
legal.
The rules
Yeah,
are illegal? No, that's what they said you can do.
but it's hard. It makes it tough because not all of my savings are in my 401k. But I'll
Yeah,
talk to you. You said I should do some research on like different kind of loans I can take out for primary residence or something. So I'll have
yeah.
to check it out.
And
But I know
FHA
that
is really powerful. Like I love the FHA loan. As low as 3.5% down, um, means you can really leverage the bank,
yeah,
for its benefits, and then pay it down so that they don't take advantage of you. So we do that. It pays down the mortgage. Now you pay down your car, etc. You now have no mortgage or car payments. So now your cash flow is even higher, and the more cash you have on a monthly basis, the faster you can do this. So it just
yeah,
accelerates. And the order I do things is I'm going to take the highest. If I just have a ton of credit card debt, and then
Highest
also the
interest rate
mortgages. I'm
first.
gonna take the highest interest, actually, like percentage amount, like regardless of amortization or not. I'm gonna take free up the lines of credit first and then re-leverage those. So I'm gonna take the highest interest lines of credit, zero those out, and then use whatever credit limit I can have at lowest interest possible,
Okay.
at the lowest simple interest, at the lowest line of credit interest possible, and use that as the vehicle to pay my loans that are amortized.
Got it.
So, people with high balances on their lines, wipe those out first, because don't treat the lines as loans.
Luckily for me, like I have no debt, so but
Yeah,
that
so you're
also means
great.
that I could be doing other things. I think having a house would be smart in terms of diversifying. Like
Yeah,
maybe even if I decide not to, maybe even if we talk about it and I talk about it with other people and we're like, yeah, maybe not this year. I think it'll be smart in the future because not having debt is kind of like I thought that was good, but then I realized not having intelligent managed debt is like limiting yourself in terms of like your diversification rate. Like when the interest rates are so low, having
it's
debt is a good
silly.
thing.
I mean, we
Yeah.
don't live in we live in a hybrid economy, right? It's and that's the whole philosophical thing, but we don't have a purely capitalist economy. We kind of have we kind of have closer to a credit economy. It's a
Yeah.
creditism, or yeah, I mean, it's creditism. It's not capitalism, it's creditism. It's how much, like the banks do the same thing. Their money is only because they borrow from
Yeah.
the Federal Reserve Bank.
Yeah. It's invisible. It's like invisible,
It's invisible
intangible
money.
money. It's
Yeah,
like stocks and like
it's made up. It's
value.
all made up.
It's value. It's not credit. It's value. Yeah.
Exactly. And so we're going to take, and this applies to literally any asset or anything that's considered asset. Asset is something that pays you. Financial definition of is something that pays you. So, anything that grows in value, anything that has a dividend or interest, that's an asset. And anything you can borrow against it, that's your leverage. So you do this, the more you pay off the minimum payments, you now have no car payment, no house payment. You have a shit ton of velocity, cash flow. You pay off all your debt. Congratulations. Well, you paid off your debt. The thing is that we celebrate that, but you're supposed to pay off your debt. It's like, congratulations, you changed your baby's diaper.
Yeah. Yeah.
You're supposed to. That's your job. So let's go to the next level. We do that. This is where you are, I think. You paid off your debt. Well, you don't have debt. You just
Yeah.
you're great with that. And sometimes, okay, I good thing I caught this before I went and paid off my student loans. I got this idea years ago, and I'm like, wait, why would I pay off my student loans when they're only 3.4% interest, when I could take a mortgage? We could take the money that I was gonna buy and put that towards the down payment on a house with a mortgage, and then pay the mortgage off, because the mortgage is even just dollar or like interest rate for interest rate, or like loans for loans, 3.4% interest. That's not my mortgage. My mortgage is 4.85% or something.
Oh, that sucks.
So
Yeah.
I'm
Don't
like,
pay your student loan. Pay the mortgage.
hey, hi, pay the mortgage first. Like,
Yeah.
don't pay your student loans. Sorry. Like I'm gonna pay the mortgage first, and then if I pay my student loans, I can't borrow against that's it. If I pay my mortgage, I can borrow against the house. If I pay my student loans, there's
You have
nothing for
nothing.
me to borrow against.
Imagine borrowing against your degree. That'd be hilarious.
That would be cool. That's a fun like financial technology, if there isn't one.
That would be some kind of startup. I bet in like 10 years there will be a startup for that.
In some sense, like the idea of profit sharing, there's some startups that do profit sharing where they'll pay for your college degree and then take a chunk of your income for the next whatever.
Yeah. Oh, that's basically
kind
that,
of
yeah.
it. You borrow against your future wealth. That would be how you borrow against your degree.
So HELOC is the same thing as a credit thing, but like on steroids.
Yes. But usually usually you're gonna have shit ton. You're gonna be higher credit limits because it's a house, it's secured. Usually lower interest rates because it's secured, and then higher credit limits because it's secured against.
But then you also have to make sure that you're still only using as much as you can pay back in like a couple months or like a year. Right?
And there's a sweet spot. Again, do the numbers, run my spreadsheet. So we got this. Now we're gonna do something cool. This is kind of where you are. Kind of where you are in that you're getting to the point where you can have a house.
I'll talk about it a little bit more. I'm in kind of like a weird situation.
Yeah, okay, great. So here we are. And now you have a paid off house. What you would do is houses buy more houses. Let's make some house babies. um, let's buy 10 houses with 20 grand each. And maybe that's a little, you know, conservative. I mean, even if it's like, I don't know, 30 grand each, 40 grand each in down payments and closing costs, you know, having more doors, having more units, you have mortgages on all of these. And the down payment just came from that first house, the equity against the first house. So this first house bought 10 more houses. And of course, now you have mortgages on all of them. Rinse and repeat, do it again and again and again until each one of these are paid off. And maybe you don't, you know, it's just maybe just leave the balance. There's some math. Some of them might make sense to pay off.
Oh, we're looking at like houses that you can buy with the 20K mortgage.
Something like that. This tool, you know, we could go over that another time. But this tool is pretty cool. Separate tool that we use to analyze deals, to estimate rehab costs, find things that are off market in like 33 plus states. Not just what's on the MLS, but off market stuff, anything for pre-foreclosure.
So I get it.
Auction.
So like in a normal market, instead of once you own your car, once you own all your other stuff, you buy houses.
Yeah. Yep. Basically, yeah. So you got assets, you got 10 rentals, you got cash flow. And at this point, it's like, well, how much is enough? That's up to you.
Yeah, you stop when you feel like it takes up enough of your time.
Yeah, exactly.
Each of those rentals takes up some time.
Okay, yeah, so that was basically what this guy Dane in our community did. That same thing when he was getting started investing in real estate. He used to be they actually him and his wife, they met at the Apple store together when they were working there, but like they didn't, like, he was super shy. He was a roofer. He was a roofer first, and then he worked at the Apple store, but he was like, you know, in the back stocking shelves and not talking to customers ideally, but he was super shy. But so getting started, this is like, you know, what you basically learn is that real estate's a people business, not a property business. So he eventually learned the skills needed to be able to communicate, to network, because Jim Rohn said that your network is your net worth. So the more people you know, the more.
That's true.
the more access to capital, the more access to time, leverage, other people's knowledge, other people's skills, etc., other people's money. So, you know, he had a $30,000 limit on a credit card that was 0% for 24 months. He did that strategy, got his education, paid off his car, etc., and did follow that to wipe out the balance. So, you know, in no time, he had freed up the line of credit. Now he had a ton of additional line of credit, or not. Well, you could. It's the same limits even, but even if you don't increase,
right? Because he paid off the 25. So
exactly, since he paid it off, you can just use it again and again and again. Now you can use it to buy a house, and so he put that on a duplex that was a rental property, and so like, you know, you can either be like super sad or super happy about this strategy, or maybe you're just like super confused. But you know, there's so much more to this. It's only the tip of the iceberg.